$12.77 million. That is the exact, staggering price tag attached to a single unit. And this is what it buys. One thawed missile interceptor, manufactured by Lockheed Martin, lighting up the night sky. Between January and April of 2026, over 250 of these specific interceptors were fired above the Middle East. This diagram shows how that math plays out. 250 intercepts equals $3.2 billion worth of hardware burned up in the atmosphere. Every single one of those empty launch tubes represents a mandatory repurchase. Because of how modern military stockpiles function, the destruction of these resources acts as an immediate, guaranteed future contract for the defense sector. Defense contractor stocks surged 40% in January of that year, weeks before the first missile was fired. The market had already calculated the likelihood of conflict. This is the ledger. It's the documented public financial record that tracks who needed this conflict to happen and why. This conflict is often framed through the lens of ideology or religion. However, to find the actual trigger for the 2026 war, we have to look back 70 years to an argument over 84 cents. Every barrel of Iranian oil extracted in 1953 followed a specific financial formula. British Petroleum, then the Anglo-Iranian Oil Company, kept 84 cents of every dollar in profit. Iran received 16. When Iran's elected Prime Minister, Mohammad Mossadegh, nationalized the oil to stop this arrangement, the response was swift. The CIA orchestrated a coup, removed the democratic government, and reinstalled a monarch who would maintain those favorable profit margins for the West. By 1974, this focus on oil revenue evolved into a global financial structure. Saudi Arabia agreed to sell its oil exclusively in US dollars, in exchange for military protection. This petrodollar system required the world to hold dollars to buy energy, allowing the United States to finance its debt through the recycling of these payments into Treasury bonds. Maintaining this dollar-denominated architecture meant suppressing any regional power that could challenge the primary oil partners. This is why Washington backed Saddam Hussein in his 1980s invasion of Iran. A strong, independent Iran threatened the Saudi dominance that anchored the entire petrodollar system. The documented history of this relationship shows a consistent pattern where diplomatic and military escalations align with specific threats to these revenue streams and the dollar's role in global energy trade. By the 2010s, the strategy shifted toward a full economic siege. Sanctions were designed to sever Iran from the global banking system, causing the value of their local currency to evaporate and domestic inflation to skyrocket. This chart tracks the collapse of the Iranian rial against the dollar. The financial cost of the siege is staggering. Since 2012, sanctions have cost the Iranian economy an estimated $700 billion in lost oil revenue, a sum larger than their current annual GDP. These centrifuges provide the only leverage left to force engagement from the West. Without the nuclear program, Iran is a sanctioned state with no diplomatic reach. With it, Washington sends high-level envoys to negotiate. The program functions as Iran's sole surviving currency. This makes the standard Western demand for a permanent end to the program a non-starter. It's an invitation for Iran to willingly surrender its final piece of diplomatic value. The 2015 nuclear deal temporarily broke this cycle. Iran reduced its nuclear capabilities in exchange for access to frozen assets and global markets. The results were immediate. Iran's economy grew by 12% as European businesses returned. Commodity mathematics explains why regional rivals opposed the agreement. Under the deal, Iran exported 2 million barrels of oil per day. Under sanctions, that figure drops to 400,000. That creates a 1.6 million barrel daily gap that Saudi Arabia and other producers step in to fill. At a price of $70 per barrel, that 1.6 million barrel difference translates into $40 billion in extra annual revenue for Saudi Arabia. When the United States withdrew from the deal in 2018, defense contractor stocks rose immediately. The working peace agreement was gone, and the sanctions, along with the massive revenue gaps they created, were back in place. The JCPOA survival was incompatible with the bottom lines of regional energy producers and American defense firms. The deal threatened a status quo that had become highly profitable for both. The 2026 blockade introduced a new method of financial warfare. Instead of using warships to intercept, the U.S. Treasury designates a region as a high-risk area. This move forces the 12 major marine insurance groups to withdraw coverage for any ship operating in those waters. Without liability insurance, global shipping halts automatically. Port authorities refuse entry to uninsured vessels, and shipping companies will not risk the loss of their hulls. The fleet stops itself. Iran countered this by offering safe passage through the Strait of Hormuz to any tanker willing to settle their oil trades in Chinese yuan. This countermove turned the world's most critical oil choke point into a filter for the dollar. By routing these transactions through China's alternative financial infrastructure, Iran bypassed the petrodollar system entirely, attacking the global demand that underpins American debt financing. This escalation transformed the regional conflict into an existential currency war. The U.S. simply could not accept a precedent that allowed major energy buyers to abandon the dollar for the yuan. Let's conduct a final audit of the tactical return on investment. In 2026, the U.S. military utilized 11 Patriot interceptor missiles to destroy a single Iranian drone. The financial balance sheet of that single engagement is telling. The Iranian drone cost $50,000 to manufacture. The 11 Patriot missiles used to stop it cost $44 million. That $44 million is billed by the contractor, RTX, to the Pentagon, which then requires new contracts to replace the spent inventory. Throughout 2025, disclosures showed that members of the House Foreign Affairs Committee, the body that votes on war powers, were purchasing shares in these exact defense firms. A 2026 advisory from Morgan Stanley noted that a protracted war would make military spending both urgent and politically uncontroversial. The report reminded investors that for these firms, the greatest threat to growth is peace. This 70-year-old financial system creates a self-sustaining cycle. When conflict is more profitable for those holding the portfolios than peace, the system functions exactly as it was designed to run.